The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. And without objection, members of the full committee, not on this subcommittee, are authorized to participate in today's hearing. This hearing is entitled An Examination of the Decline of Minority Depository Institutions and the Impact on Underserved Communities. And I know that we're in competition this afternoon from several different pieces of different hearings. I expect members to become running in and out. So I now recognize myself for 4 minutes to give an opening statement. To my friend and colleague, Ranking Member Lukamaya, members of the subcommittee, welcome to this hearing on the decline of minority depository institutions and the impact on underserved communities. This hearing continues our consideration of the challenges faced by disenfranchised, marginalized communities, including in particular communities of color that face discrimination in access to financial services. It is regrettable in many ways that in 2019, we still need to hold hearings to draw attention to the systemic challenges and structural discrimination faced by minority communities. It is frankly regrettable that in 2019, we must still talk about the challenges faced by Asian banks, Hispanic banks, African American banks, Native American banks, and the dramatic disparities in lending to minority communities and low and moderate income communities. But the data and the generational impact is irrefutable. Today we consider not only the problems, but we also have a substantive conversation about actionable solutions. A discussion of a draft of a bill I plan to introduce that was attached to this hearing. The bill seeks to tackle several key challenges faced by minority banks, including in particular those that focuses primarily on serving underbanked, unbanked, and low-income communities. Specifically, the bill on which I look forward to feedback from our panel of experts here today addressing the following. 1, access to capital. Overall, minority banks are smaller than their peers and typically well below $1 billion in assets. These banks pose no credible systemic risk and focus on underbanked communities, investing in home ownership and small business lending in LMI communities. Given the communities they serve, these banks often struggle to mobilize savings to redeploy in their communities. My bill tackles this by making it somewhat easier for minority banks that are also community development organizations to raise capital from private investors, from opportunity zone funds, and pushes the federal government to deposit funds that are fully insured within these institutions. Regulator engagement. The bill calls on the regulators to harmonize and strengthen their minority bank advisory boards and take ownership of their failings in the area of diversity. Specifically, the bill calls for regular auditing of the diversity of the Bank Examiner Corps, publication of the data, and consideration of how the lack of diversity in this area and lack of special training of examiners engaging with minority banks and low-income communities harm their effectiveness. The bill also calls on the prudential regulators to consider more effective and coherent CRA examination of minority banks that are also community development financial institutions. Funding the CDFI fund, finally, the bill calls on Congress to fully fund the CDIF fund of the Treasury Department. The CDIF fund is a unique tool which leverages limited government funding to crowd in significant private sector capital and foster innovation, investments, and market-oriented solutions to tackle some of our nation's most persistent challenges and poverty alleviation. This program deserves strong bipartisan support. In closing, I wish to highlight that I am very aware that while today's hearing is very focused on minority banks and issues of discrimination, we absolutely need to also tackle head-on. And I recognize that any discussion of banking deserts and underbanked communities must also include consideration of rural and agricultural communities. These issues cut across districts and party affiliation, and I look forward to working with my colleagues on a bipartisan basis to tackle these important challenges. I look forward to the testimony of our witnesses here today. And I yield back the balance of my time. And I now recognize the ranking member, Mr. Lukamaya, for 5 minutes for an opening statement.
Thank you, Mr. Chairman. Minority deposit institutions, MDIs, like all financial institutions, have struggled under the weight of the regulatory burden of Dodd-Frank. According to a Harvard University study, Dodd-Frank has created an uneven regulatory playing field. This playing field resulted in additional legal and compliance costs for small institutions, preventing them from serving their customers, particularly the businesses and consumers within their community. MDIs play a unique role in serving their community. According to the FDIC and the Fed, MDIs serve consumers in low to moderate income communities at higher rates than non-MDIs. This committee should be focused on alleviating the burden on these institutions so they can serve their community, specifically minority and LMI communities. One such burden that will have a devastating effect on small depository institutions, and particularly minority depository institutions, is the proposed CECL accounting standard. Now, as many on this panel know, I could spend the length of this hearing discussing the pitfalls of this ill-conceived proposal. Instead, I will simply read an excerpt from a letter to this committee regarding CECL from the National Bankers Association, which identifies itself as the voice of minority banking in the United States. And I quote, "To the extent that CECL increases the cost of lending to borrowers that are perceived by regulators as being riskier or of lower credit quality, such as low and moderate income consumers and small businesses located in low and moderate income communities, the economics of our lending decisions could be altered dramatically. This would further restrict access to credit for consumers and businesses that already experience limited credit options," end quote. In addition, I would like to read a statement from the Center for Responsible Lending, President Mike Calhoun, on CECL, in which he said, and I quote, "As proposed, CECL creates a significant disincentive for lenders to originate loans to low and moderate income families and communities of color," end quote. I would like to ask unanimous consent that the full statements from both of these organizations be entered into the record.
Without objection.
Statements I just read are not unique. The truth is numerous consumer and industry groups have voiced concerns over CECL. Despite the warning signs these groups have raised, this committee has not taken any formal action to better understand the effects of CECL and what it will have on low to moderate income consumers and minorities. No full committee hearings, no subcommittees, no markups, no nothing. This inaction flies in face of LMI borrowers and minority communities across the country who will be adversely affected by this accounting standard. For all of the rhetoric from the other side of the aisle about how consumers and minorities can struggle in the financial services industry, the Democratic leadership on this committee remains woefully silent on the issue that has direct impact on minority depository institutions and the consumers they serve. I specifically mentioned that the Democratic leadership of this committee has been active because CECL is a bipartisan issue that has support from members on both sides of the aisle. 52 bipartisan members have signed on to a bill to delay implementation of CECL until a study is completed that examines access to credit for consumers. In addition, roughly 30 members of this committee just last week signed a bipartisan letter I sent to FSOC urging the Office of Financial Research to study the impacts of CECL. Despite this bipartisan support, the chairwoman of this committee has done nothing to address an issue that could devastate low and moderate income lending and lending to minority communities. In front of this committee today are witnesses representing 3 separate organizations that have voiced concerns over the effects of CECL that they could have on their member institutions as well as the consumers they serve. And yet, this committee has shown no interest in bringing this issue up, and in fact seems completely content to let CECL go into place despite the warning signs related to minority and low-income borrowers. This committee is tasked with ensuring a healthy financial services industry and promoting economic freedom for everyday Americans. That responsibility includes ensuring financial institutions are not driven out of the marketplace by onerous requirements and protecting the ability of consumers to gain access to credit. With that said, I urge all my colleagues on both sides of the aisle to call for a committee hearing on CECL, and better yet, have FASB come before this committee and defend this standard. I yield back.
Now you have 1 minute to the gentleman from Georgia, Mr. Scott.
Yes, thank you, Mr. Chairman. I do want to let my colleague from Missouri, Mr. Lukemeyer, I agree with him and work with him on CECL, but I also want to say that, to clarify that Ms. Waters, who is chairlady of this committee, is very much concerned about the status of minority-owned and depository institutions, and she's asked us to look at that, as well as she have an open mind to the CECL question as we get to it. In my last few seconds, it is very important. Banks are the heart of our financial system. And with the growing population among minorities, there could not be a more crucial hearing than today, Mr. Chairman, and I look forward to a very excellent hearing. Thank you.
Thank you. The gentleman's time has expired. Today we welcome the testimony of first Mr. Kenneth Kelly, who is the chairman and CEO of the First Independence Bank and chair of the National Bankers Association. First Independence Bank, headquartered in Detroit, Michigan, is now the 7th largest African-American controlled commercial bank in the country. He's been appointed to the Fed's Community Depository Institutions Advisory Council for a three-year term, and has been appointed nationally to the FDIC's Community Bank Advisory Committee. Next, we'll hear from Ms. Jill Sung, President and CEO of Abacus Federal Savings Bank in my home city of New York, and chair of the Independent Community Bankers Association Minorities Bank Council. Ms. Sung joined Abacus, the bank her father started in 1984 as vice president and general counsel in 1996, later rising to executive vice president and then taking over as president and CEO in 2005. She serves in several leadership positions within the Independent Community Bankers of America, as chair of the Consumer Financial Services Committee and as chair of the ICBA's Minority Bank Council. Ms. Mara Falero, Vice President of Marketing and Communications, Jetstream Federal Credit Union, a low-income CDFI operating in Miami-Dade County, Florida, and Puerto Rico. She has over 33 years of financial institution experience in both credit unions and banks, and she's very active in her community, serving on several chamber and credit union boards, past chair of the Town of Miami Lakes Economic Development Committee. Mr. Jeff Bowman, President and CEO of Bay Bank, a tribally owned bank with the Oneida Indian Tribe of Wisconsin. Mr. Bowman has over 30 years in the banking industry, with the majority of his career working in bank management and commercial lending positions. He specializes in helping small businesses, providing technical assistance. He's also active with several organizations that facilitate economic development and small business development. He specializes with assisting and capitalizing minority businesses, particularly Native American-owned small businesses. And last but not least, Mr. Aron Betru, Managing Director, Center for Financial Markets, Milken Institute. He has over 20 years of experience and leads the center's access to capital and strategic innovative financing initiatives to enhance social impact, both in the United States and developing countries. He also leads the Institute's work on opportunity zones and qualified opportunity funds. Mr. Betru was a member of the steering group for the Blended Finance Task Force launched by the Business and Sustainable Development Commission, as well as co-chaired the Partnership for Lending in Underserved Markets, a joint initiative with the U.S. Small Business Administration. He's also a term member of the Council on Foreign Relations and is a member of the Board of Directors for the Calvert Impact Capital and FHI Foundation. So, witnesses are reminded that your oral testimony will be limited to 5 minutes, and without objection, your written statement will be made part of the record. Mr. Kelly, you are now recognized for 5 minutes to give your oral presentation of your testimony. Turn on your mic.
Thank you for the opportunity to testify on behalf of First Independence Bank and the National Bankers Association. I serve as chairman and CEO of First Independence Bank, a $272 million MDI headquartered in Detroit, Michigan. We're the only African-American bank in the state of Michigan and one of only 2 banks in the city headquartered in Detroit, and we're also a community development financial institution. I also chair the board of directors of the National Bankers Association, the leading voice of MDIs since 1927. Our banks are in crisis. They fail at a higher rate, and while there's broad diversity in the MDI sector in terms of profitability, mission-oriented financial institutions encounter unique challenges ranging from investors who don't understand the value of the services we provide, and oftentimes regulatory review that does not understand the communities we serve. We are the banks of first and last resort of our communities. Relative to non-MDIs, we do more small business and mortgage lending on a pro rata share. We often do specialty lending in terms of religious institutions and other community-based organizations. We fully understand the value of our work, but absent intervention from Washington, fewer of our banks will exist to do this work. The top issue for MBA members is raising capital, as been mentioned. Congress can take 4 steps now to alleviate our capital raising concerns by 1, amending the Community Reinvestment Act such that the majority institutions automatically receive positive CRA consideration in addition to enhanced CRA credit for equity investment in MDIs. 2, amending the Investment in Opportunity Act such that MDIs are eligible for equity investments. 3, exempting MDIs under $3 billion from the Bank Holding Company Act and change of control provisions. And 4th, creating an investment tax credit for equity investments in MDIs. Congress can also act now to help our banks diversify their deposit bases by 1, lowering the barrier to participation in the Minority Bank Deposit Program, and 2, modernizing the Federal Deposit Insurance Act approach toward broker deposits so that smaller MDIs can diversify their deposit bases. Congress is also well positioned to use existing tools like the Community Development Financial Institutions Fund to create a fairer process for new markets tax credit allocation and to urge congressional appropriators to increase funding for all CDFI programs. Should it become law, Congress should leverage the Improved Access to Traditional Banking Act to create a fund for MDIs for financial literacy and alternatives to predatory products. Targeted deregulatory measures would benefit the MBA banks. The current leadership in the industry, the executive branch, and regulatory environments are working collaboratively within its constraints today. Examples include the bolstering of the Treasury Mentor Protege Program and the FDIC's MDI Roundtable. But there is an immediate need to streamlining BSA/AML reporting requirements for smaller banks, and still a need to strengthen Section 308 of FIREA, requiring that significant regulatory developments include an impact analysis on MDIs and support MDIs' sustainability. In order to do the work that we do, we often look to Washington for support. The actions outlined above and in our written submission provide a roadmap for helping us to do this. Examples of those include actions taken by the forefathers of this great nation. One included creating the Federal Reserve in 1913, creating the FDIC in 1933, and in particular to MDIs, creating the Freedmen's Bank over 154 years ago in 1865. You will hear a recurring theme throughout the hearing that demonstrates that leadership matters on issues related to these institutions, and in particular, policy matters more. We commend the subcommittee and Chairman Waters and Meeks on their long-standing leadership on MDI issues, and most importantly, for holding this hearing. I look forward to taking the subcommittee's questions. Thank you, Mr. Chairman.
Thank you for your testimony. I now recognize Ms. Song for 5 minutes.
Chairman Meeks, Ranking Member Luke DeMeyer, and members of the subcommittee. I am Jill Sung, CEO and President of Abacus Federal Savings Bank in New York. I testify today on behalf of the Independent Community Bankers of America, where I serve as chair of the Minority Bank Advisory Council and the Consumer Financial Services Committee. Thank you for this opportunity to testify at today's hearing. MDIs play a critical role in promoting economic prosperity in historically marginalized communities. I'd like to thank Chairman Meeks for his work on a thoughtful discussion draft. We are pleased to have the opportunity to offer input on this draft and hope to continue to work with you as it advances through the process. Abacus Bank is a $350 million asset privately held savings and loan association headquartered in Chinatown, New York City, with branches in Chinese American communities in Brooklyn, Queens, Edison, New Jersey, and Philadelphia. Abacus was founded in 1984 by my father, Thomas Sung, who immigrated through Ellis Island as a teenager from China. He went on to attend law school and eventually opened his own immigration law practice in Chinatown to help others like him find a better life in this country. He was motivated to open Abacus Bank by the realization that banks were more than happy to take his deposits, but were not willing to give him or people like him a loan. Abacus was founded to change that and to ensure that our community has access to credit, a fundamental factor for the economic stability and growth of any community. Majority of our lending is in residential mortgages, particularly first-time home buyers, a natural fit for our community where the aspiration of owning your home is almost sacred. We also lend on small multifamily and mixed-use investment properties. Our lending policy is extremely conservative, and our delinquency rates have always been unusually low before, during, and after the financial crisis. We attribute this to our deep understanding of our customers, and we are very proud of how we helped our community over the past 35 years and look forward to serving future generations. I would like to speak to some of the unique challenges we face as an MDI that serves immigrants. These challenges reflect the vulnerabilities of our customers in the financial system. The first is the language barrier. Because most of our customers speak Chinese as a primary language, we must hire employees who are fluent in Chinese. This limits the supply of qualified employees, and we often have to hire people with little or no banking experience and train them at a significant expense to us. The language barrier also increases our operating costs as we spend much of our time translating and explaining to our customers disclosure forms and regulatory concepts where there's often no literal translation in Chinese. The language barrier makes implementing a regulatory change, of which there have been many in recent years, twice as costly and time-consuming. The second challenge is serving customers who come from a starkly different cultural and socio-political system. Many of them view not only the government but the banking system with deep suspicion. In order to overcome this lack of trust, we must heavily invest in financial education. We feel a tremendous responsibility to act as trusted advisors to this vulnerable population and guide their decisions while at the same time respecting their concerns. Technology, which is transforming financial services, is not always suitable for this population. Some of our most popular products are safe deposit boxes and passbook savings accounts, old school products, which cannot be automated and are costly and labor intensive for us to maintain. Despite this, we continue to offer these products to ensure that the particularly vulnerable pockets of our community, like the elderly, still have access to the banking system in ways they feel safe and comfortable to use. As a small MDI, our business model does not easily lend itself to high margins and high profits. This is why access to capital is so key. We do not have access to public capital markets, and raising private capital through the regular channels is challenging, given our specific missions and our concentration in disadvantaged communities. I know this predicament of lack of capital faces all MDIs. We need to find ways to help MDIs obtain capital, such as reducing our regulatory costs so we can retain more of our earnings, diversify our income stream, and come up with new, non-traditional ways of raising capital. This is critical for our preservation and to ensure that fair and equitable access to the financial system is preserved for all. When we look at Chairman Meek's discussion draft, this is the perspective we bring: the unique challenges I've discussed and the need for new capital resources. My written statement provides a more detailed assessment of the draft. I would like to thank you again for your work on the promising constructive draft. We hope to continue to work with you to ensure the legislation reaches its true potential for strengthening MDIs in the communities we serve. With that, I'm happy to answer any questions you may have.
Thank you. Now I'll turn to Ms. Falero. You're recognized for 5 minutes.
Good afternoon, Chairman Meeks, Ranking Member Lugemeyer, and members of the subcommittee. My name is Mara Falero, and I'm testifying today on behalf of NAFCU. I currently serve as the Vice President of Marketing and Communications at Jetstream Federal Credit Union. We appreciate the opportunity to share our views on the important role that minority depository institutions serve in our economy. Jetstream Federal has over $200 million in assets and serves more than 18,000 members in Miami-Dade County and parts of Puerto Rico. Jetstream Federal is an NCUA-designated low-income credit union, a minority depository institution, as well as CDFI certified. All our employees are community development certified financial counselors. This program trains our staff to identify financial distress within our membership and proactively work to prevent financial catastrophe. Our membership is diverse and reflective of the communities we serve. 71% of Jetstream members are classified as low income, of which 40% are extremely low income. 68% of our members are Hispanic, of which 27% are Puerto Rican, and 19% of our membership is African American. Jetstream Federal is also a Juntos Avanzamos credit union, which is a community of credit unions committed to serving and empowering Hispanic communities. We were the first credit union in Florida to receive this designation. Jetstream Federal is committed to meeting the needs of our members, which has led us to offer a number of products to help newly arrived immigrants and those with lower incomes, such as a second chance checking program, no credit check loans, and even a resettlement loan program for those moving from Puerto Rico to the mainland. Due to the areas that Jetstream Federal serves, Hurricanes Irma and Maria critically affected our members in 2017. These hurricanes were a life-defining moment for many of our members, and we knew we had to act. Jetstream Federal provided $2.5 million of critical financial relief to our members during the first stages of recovery, including no-cost 0% APR short-term loans, deferment of existing loan payments, elimination of transactional fees, and financial coaching for our members who were dealing with insurance cases while attempting to rebuild their homes. The credit union industry strives to lead when it comes to diversity, equity, and inclusion. The majority of credit union CEOs are women. The majority of MDIs are credit unions. 528 in 2018, according to the NCUA. MDI credit unions serve 3.9 million members and tend to be smaller institutions. 87% of MDI credit unions have assets of less than 100 million. They also tend to underperform growth in all categories, including asset size, membership, and loan volume, in comparison to the rest of the credit union industry, largely due to a decline in membership. In my written testimony, I outline in detail several areas where Congress can act to help credit union MDIs, such as Jetstream Federal, and these include, first, fully funding the Community Development Financial Institutions Fund program. These grants have been an important tool for us to serve our members, allowing all credit unions to serve underserved areas. Field of membership restrictions on credit unions, such as Jetstream, hamper our ability to serve those in neighboring counties who have the same needs as our members. Making it easier to charter new credit unions by providing greater flexibility in the Federal Credit Union Act and giving NCUA the appropriate tools. This includes ensuring that NCUA has the authority it needs in areas such as credit union capital, subordinated debt, and loan maturity limits. NAFCU is generally supportive of the efforts in the discussion draft of the Insurance, Diversity, and Community Banking Act. In particular, we are pleased to see the idea of creating an MDI advisory committee within each regulator. We welcome the opportunity to continue to work with the subcommittee as you consider legislative approaches to address this critical issue. In conclusion, credit unions are proud of the work we have done to serve minority and underserved populations. Still, MDI credit unions face a number of challenges. We urge this subcommittee to support efforts to improve the regulatory environment for MDI credit unions and modernize the Federal Credit Union Act. Thank you again, Chairman Meeks, Ranking Member Luetkemeyer, and the members of the subcommittee for the invitation to testify before you. I welcome any questions you might have.
Thank you. I now recognize Mr. Bowman for 5 minutes.
Good afternoon, Chairman Meeks, Ranking Member Luetkemeyer, members of the subcommittee. My name is Jeff Bowman. I'm the president and CEO of Bay Bank. We are a small community bank located in Green Bay, Wisconsin. Our bank is owned by the Oneida Nation. One of the things that makes us unique as an MDI is there are only 18 Native American-owned institutions in the entire country out of the approximately 5,500 FDIC-insured institutions. We're also the smallest bank in Green Bay. Part of the Oneida Reservation overlaps the city of Green Bay, so we have a urban and a rural market in which we solicit our customers from. Some of the services that we're very strong in and committed to community and economic development is a small dollar loan program. We do not base our credit decisions based on credit scores. We look at expanded guidelines. This creates increased access, and it helps move people out of predatory lending. There is a huge problem with Native American people utilizing payday loan stores and short-term lenders where a $500 loan turns into a $3,000 debt. So we dedicate a lot of resources to make sure that we have a robust and easy-to-access small dollar loan program. We're also very strong in mortgage lending. One of the original reasons why the bank was started in 1995 is during the 1990s, there were a lot of bank mergers and acquisitions that left a void in community banking, Green Bay included. There was no small institutions, so the Oneida tribe partnered up with some local investors, started a brand new bank. One of the reasons why the tribe was interested in forming the bank is making sure that their tribal members had access to financing to purchase a home. So if you are familiar with reservation communities, much of the land is checkerboarded, where it's a combination of fee land and then trust land. It's difficult to obtain a mortgage on trust land, especially when you go back in time to the 1990s. So one of the reasons of forming the bank was making sure that the bank was going to be the responsible party and figure out a creative way to make mortgage loans on trust land. So we're very good and strong in that space. We've originated over $90 million worth of mortgage loans to Native American borrowers throughout the Great Lakes area. So we've figured out how to solve that problem. We're also very active in the small business space. Minority small business owners, we don't always feel get a fair shake. And when they apply for a business loan at Bay Bank, they're going to have a Native American person and management team looking at their credit decision. So what's interesting in everybody's story and testimony here is we all have unique stories about our neighborhoods and our communities that we love. They could be ethnic-based, they could be low to moderate income. And one of the things that's encouraging in this bill is the formation of the advisory committee in which we have a voice. This is the first time that a Native American bank has had the opportunity to come and talk about what we do. So we all have important stories, and we all need additional resources, but this advisory committee has an opportunity to share these stories with bank examiners. We are a $100 million bank. We're the smallest bank in our community, but we're not just a bank. We affect social change. We're also a CDFI. We have an outstanding CRA rating, and we wear that like a badge of honor. We earn that. So it's important that we recognize the efforts that MDIs are doing, and I think that's got to trickle down to the bank examiner level to let them know that you're not just looking at another $100 million bank. You're looking at an institution that's affecting change. So this bill has got the opportunity to heighten the awareness of MDIs, bring them additional resources, and we are in favor of that. In my testimony, I paint a picture of what the Oneida community looks like. We have a 22% poverty rate and a 9% unemployment rate. There are 11 tribal communities in Wisconsin, 11 federally recognized tribes. Oneida has some of the strongest economic indicators. So when I mentioned 22% poverty rate and 9% unemployment, there's several other communities where it's much worse. So there is a role for what we do. We appreciate this opportunity to tell our story, and we hope that you take this to the next level and keep bringing us additional resources so we can keep doing the work that we love to do.
Thank you. And last, I recognize Mr. Betru for 5 minutes.
Thank you. Thank you, Chairman Meeks, Ranking Member Lukemeyer, and members of this committee. It's an honor to be here. My name is Aron Betru. I'm the Managing Director for the Center for Financial Markets at the Milken Institute. The Milken Institute is a nonprofit, nonpartisan think tank that promotes evidence-based research that serves as a platform for policymakers, industry practitioners, and community members to come together and address challenges we face here in the U.S. as well as globally. For the past century, steady economic growth and ongoing job creation has led to prosperity in the United States. However, not all segments of society have been able to participate fully in this prosperity. Inequality does exist. Ensuring all segments of society have an equal opportunity to contribute and benefit when the economy grows is critical to an equitable and just society. Minority depository institutions play a vital role here in promoting financial inclusion and economic viability for underserved communities by virtue of their presence and focus. However, yes, their numbers have dwindled. Those that remain today are limited in their capacity to serve their communities. I would like to focus my comments today from both a bottom-up institutional but also a top-down economic perspective on understanding the decline of MDIs, as well as how to reverse this decline, all with the perspective of improving access to capital for underserved communities. From a bottom-up institutional perspective, I recently served as the co-chair of Partnership for Lending in Underserved Markets, a joint initiative of the U.S. and Small Business Administration and the Milken Institute to promote access to capital for minority-owned small businesses. Small businesses are the backbone of broad-based economic development, but unfortunately, over the past decade, the United States has seen a significant and growing underrepresentation of minority-owned enterprises. In our work, we identified a series of factors as contributing to this situation, but one in particular stood out: access to capital. Without sufficient access to capital for a small business, not only were they limited in their ability to grow, but those individuals in the community that would have been hired lost out on jobs. Those individuals that the businesses would have provided in terms of services, from a grocery to a computer store to a daycare, never happened. In this context, a lack of access to capital contributes to a lack of access to the American dream. As you have noted in your committee memo, a combination of factors emerged as contributing to a lack of access to capital. The 2008 financial crisis fueled bank closures and home value reductions in minority neighborhoods, the collateral for these loans. This was exacerbated by longstanding bias in the banking sector. This is important because bank loans nationally are the second most prevalent source of startup capital for a business. But for minority-owned businesses, it's a credit card, a far less efficient source of capital for funding long-term growth. It's been well documented. The Office of the Comptroller and Currency recently as well confirmed, if you compare MDIs and Community Development Financial Institutions, CDFIs, to other banks, MDIs and CDFIs disproportionately focus on low-income communities. However, MDIs are small in the broader commercial banking context, and the result of this small scale is increased susceptibility to challenges associated with increased compliance costs, operational complexity, and fast-paced technology-enabled competitive markets. If enhancing the scale of their impact is a target, understanding improvement strategies of MDIs and how to resource them is critical to assuring MDIs can be greater economic development engines for underserved markets from the bottom up. Now, from the top-down economic perspective, we're sitting in the tail end of one of the longest periods of economic expansion for this country. Yet for the past 30 years, median household wealth for African American and Hispanic in particular have declined by 75% and 50% respectively. A recent study by McKinsey & Company detailed that closing the racial wealth gap, just looking at black and white Americans in particular, could mean improving the US GDP by as much as 7%. That's $1 trillion. As a demographic shift and minority groups become a majority of the US population, it is no longer a nice to have. It's an economic imperative to promote access to capital to these communities in order to grow the US economy and retain our global competitive advantage. And we must meet this challenge with the full weight of US public policy, and I believe MDIs are a part of this. Now, in my written statement, I have provided a more detailed set of comments and recommendations revolving around a series of issues, but I'll just mention 3 right now. 1, promoting increased federal deposits to MDIs. 2, exploring the potential of MDI fintech collaborations. And 3, enabling opportunity zone investments into MDIs and CDFIs. Let me conclude here. I thank you for this opportunity, and I look forward to the discussion today.
Thank you. Thank you for your testimony. I want to thank all of the witnesses for your excellent testimony. And I think this might be the first time since I've been chair, all of you did it within 5 minutes. So that, I didn't have to use the gavel one time. Thank you. So maybe what we'll do in this round, I'll recognize myself to ask questions for 5 minutes, but it'll give you an opportunity to put some more meat on the bones of what you may have testified. I'll start with Mr. Kelly. Can you please tell us and speak to the challenges that MDIs face in seeking to raise equity capital to achieve scale?
Certainly. When you think about minority banks and their mission focus, one of the challenges has been they've been measured to larger institutions. And by default, what happens is they assume that they're not as profitable, or their intent in terms of what they're trying to approve from a pre-tax return on assets is not worthy of investment. So you have I'll call it intra-industry issue. We also have now an inter-industry issue where we're seeing technology companies are moving in and being able to attract capital, move into the logistics of moving money in a way that is attractive to investors. One of our reasons for asking this committee to support us is to allow us to demonstrate with the proper scale and the proper focus, our institutions can grow, be mission-oriented in serving the lower, moderate-income communities, but also be profitable.
Thank you. Ms. Falero, your bank is designated low income by NCUA. What advantages do you have with such designation, and how does NCUA work with you as a result of those?
Being a low-income credit union allows us to serve the underserved better. CDFI certified also gives us a greater opportunity to be able to serve our community, and the grants that we receive from the Treasury that we've received, about 2 grants, help us rebuild some of our loans in Puerto Rico. It's helped us do resettlement loans in Puerto Rico, and has also helped us make people whole in Puerto Rico by assisting them with all the items that they can't afford, that insurance doesn't cover. For example, you know, your furniture, your patio furniture, all of that other type of loans that they're not able to access. So we've been able to do a good job with those loans.
Thank you. And Ms. Sung, listening to Ms. Falero, do you think that other regulators should have designations similar to NCUA's low-income designation for banks? And what could some of those advantages and disadvantages be if they did?
I think that any opportunity that we have to be able to obtain more access to capital, whether it's through a designation, as you stated, is important. At this point now, I am not clear, though, based upon the bills that I've seen, whether or not that would allow us to be able to access capital. I am concerned that as we create this, this issue of trying to gather more data, and we create data creep in our process, that the things that we do naturally and the things that we already do will be stymied as we try to meet certain requirements that are new. And I will tell you that as a CRA, my CRA rating has been outstanding for many years. And I know over 55% of my loans are to low to moderate-income borrowers or census tracts. And I feel already in what I do, I should be able to access that capital or grants that may be necessary to help us survive.
Thank you. Mr. Bowman, trying to include everybody here. Does the government do enough to leverage programs at its disposal to deposit funds in MDIs? And what more do you think that we or the government can do in this area?
So I'm not an expert on that, so I may not have the perfect answer. However, the only experience I have is a couple years ago I went to a minority banking conference put on by the joint supervisors, FDIC and OCC. There was a pamphlet advertising the minority banking deposit program. It had an application, fill this out, we'll contact you. I had a bad experience. I filled out the paperwork, sent it in, couldn't get a real live person to call me back. At that point in time, I just figured we're on our own. So this bill has the opportunity to create access and creating agents that would help with reciprocal deposits. Every bank in this room needs deposits to make loans. So any opportunity would be appreciated.
Thank you. Last, Mr. Betru, I'm interested in your comment about closing the wealth gap. Can you articulate more about that, how, you know, MDI banks would help?
Sure. We're all well aware that essentially when you look at the biggest driver of wealth creation in this nation, it definitely comes from the small business sector. In the small business sector, when you look at post-2008, a number of things happened in minority neighborhoods. Where the biggest source of collateral that was used typically for small businesses was a home equity value. After 2008, where in some zip codes in minority neighborhoods where the value dropped by more than 50%, that collateral was not there anymore. Couple that with my previous statement with regards to the closures of the banks, you had a perfect mixture of issues that actually prevented access to capital. If we want to create wealth to actually bridge this gap, we have to think about providing the right type of capital, providing the right type of loan products, equity, as well as debt to minority-owned businesses so that they can actually grow those enterprises, but also hire more in their neighborhoods. From there, then we can actually be in a much better position to create the wealth in minority neighborhoods to be able to address the gaps that we've been seeing across 30 years.
Thank you. Thank you very much. I now yield to the ranking member, the gentleman from Missouri, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman, and welcome to the panel today. First question is from Mr. Kelly. Your testimony states that First Independence Bank remains, like so many CDIs, the bank of first and last resort for the communities that you serve. In addition, the letter from the national bankers that I read in my opening statement said CECL would further restrict access to credit for consumers and businesses that already experience limited credit options. Can you describe what limited credit options look like for individuals that your bank serves in your community?
Thank you, Ranking Member Mr. Lukemeyer. What we find is that alternative financial services become very challenging for people. They're very expensive for individuals to have to do check cashing, to have to do payday lending, et cetera. What our bank and what banks like ours do is provide those individuals another opportunity for financial alternatives. And that's what I'm describing in that comment.
Well, my concern is, and I think I'm anxious to hear your response here, but I believe that CECL will raise the cost of loans that you give, because in order to reserve for those, you're going to have to find the income from someplace, and to me that limits access to credit. What would happen if access to credit to those consumers were further restricted due to CECL? Where would those individuals go, or what would they do?
I think exactly as you just referred to, I think they will have to resort to alternative lending. If I heard your comment correctly, you were asking, does CECL put constraints on our business? Is that correct?
Right.
The answer to that is yes. In fact, I think we've all would agree on this panel that the discussion of CECL being delayed was something that we were very proud to hear and celebrated. That has not been our primary fight at this point because we are talking about issues such as capital. But your question and your premise is exact in that if we had to adhere to that, it would create even more pressure for institutions like ours.
Very good. Ms. Falero, your testimony states that 71% of your customers are low income or below, and 68% of your customers are Hispanic. If the statement I read from the Center of Responsible Lending is correct and CECL restricts lending to LMI and minority communities, what will that do to your business model and your customer base? And I thank you also. I know your association was very prompt in getting to me information with regards to the effect on your credit unions.
Congressman, the effect on CECL on credit unions, not only our credit union, would be a tremendous regulatory burden and additional compliance costs. So we would be spending more money dealing with that and giving us less opportunity to deal with our actual members that need us.
You know, when we've had in this committee before, the testimony from the Home Builders Associations for every $1,000 have increased in a home loan of 100,000 people across the country no longer have access to home mortgage lending. And, you know, to me, credit unions and small banks, community banks, are the crux of where this CECL accounting standard is going to hit, and the very people that need access to the credit, low and moderate income folks, where your business model is. Those are the folks that you take care of. And so it's very concerning to me that this is it's going on, and I appreciate your response to that. I think in the letter you said that your capital would be affected roughly $14 to $15 billion. How do you recover that? What's your revenue stream? Put it that way.
I couldn't even answer that right now.
Probably interest rates and fees on the loans, right?
It would have to be, yes, and that's something that
So you're going to raise the cost of the loan, which restricts the ability of people to have access.
Exactly, and that's not the way our operating model works.
Perfect. Ms. Sung, your testimony states that CECL might make sense for larger institutions, but is misapplied to your institution and its peers. Can you elaborate on that statement? And when you say peers, do you mean small institutions or MDIs?
Smaller institutions and MDIs.
Okay. How would it affect you?
I think the cost of compliance is unknown right now, and that's what's scaring us. Also, the uncertainty of how the regulator will look at CECL once it's in effect is what's worrying us as well. So as a result, we have to probably spend money in consultants, and that will cost money and time for us as well.
Do you believe there's a pro-cyclical effect? In other words, whenever the economy turns down, you're going to have to reserve more, and therefore you have to raise costs, and it just keeps spiraling the wrong way. I see Mr. Kelly nodding his head. You agree with that?
Yeah, I mean, there's no other way to understand that otherwise.
Ms. Valero, you agree with that? Mr. Bowman, I see you shaking your head. Mr. Betru, you also as well. I see my time is up. Thank you so much for your comments today. I appreciate it. Yield back.
Now I recognize the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Mr. Chairman. Let me just commend you. This is an extraordinarily important and critical issue. And let me tell you just how critical this is. You have to put it in the framework of a history of our country when it relates to this issue, paramount of which came during the Civil War. You know, when Alexander Hamilton, even during the Revolutionary War, when he set the principles and the foundation of our great system, wouldn't have been here without that great centralized banking system, which required every state of the 13 states at that time to have a bank and organize it into a major central bank to power. But something happened just a little while later. It was a civil war. Tore the whole country apart, which ripped this banking system apart. But it had to come back together very quickly. But here's the point. It didn't come back for 4.5 million black slaves. But they realized that they had to do something. And that's where the Freeman's Bank came. And then later on with Plessy Vergus Ferguson, separate but equal, they wouldn't let the black folks go in the white folks' bank, so they had to get black banks. Here's my point. Right now, you got Mr. James Ballantyne, who's just left. He's president of the American Bankers Association, African American. Mr. Kelly, you're president of the National Bankers Association, African American. Wonderful. What I'm saying, the pieces are here. But the energy, the thrust, the urgency of this government to respond to this is not. Now, we had 4.5 million slaves there without banking. What did? They put the Freedmen's Bank. Then what Plessy Vergus Ferguson did, they had to put the banks in each of the former Confederate states where there weren't none. Government policy moved to that. The reason I'm saying that, the answer to our unbanked and underbanked population is to bring and give this as a tremendous seeding opportunity. What better group of banks do we have to service and get in there so that we can reduce this unbanked? There are 58 million unbanked and underbanked people. So anyway, now that I've got my sermon out, let me get to my question. I want to get to you, Mr. Kelly, and I want to get to each of you. What should we in Congress be doing to take steps now to get more of these banks in? There is not. We have agencies for everything, but not this. We used to have some efforts, but unless we get an institutionalized approach, that there is an entity here in the federal government whose sole purpose is to increase minority depository institutions and have that as a primary goal of being able to enrich the banking system by solving this. It's a shame to have 58 million unbanked and underbanked. Say you on that. What else should we be doing?
Congressman Scott, thank you for that, and it aligns with my opening statement. We talked a little bit about the creation of the Federal Reserve System in 1913, the FDIC in 1933.
Yeah.
My point was that leadership matters, but policy matters more. And so to your point, which is how do we help support the unbanked and underbanked. There's a bill right now, Improving Access to Traditional Banking Act. We need to make that happen soon. We need to ensure that there is a fund created for MDIs to support financial literacy and alternative predatory products. That's the thing that I would say immediately. But the second thing I would say
Thank
is,
you for that. That's my bill. That's on that. And I didn't ask for that commercial.
he did not, but
you see, the energy is on this committee to
Yes.
really get institutionalized on this. And if they did it for the slaves coming out of the Civil War, 4.5 million, surely we can do it to really solve the problem of getting to 58 million underbanked. One other point, I know, Ms. Shevin, you want to make my point here, but do you all know, and I'm finished after this, do you all know that there has not been an additional African-American owned bank in 20 years since 2002?
Gentleman's time has
Rest my
expired.
case. Thank you, Mr. Chairman.
The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Dodd-Frank greatly increased compliance costs on smaller institutions throughout the country. No? Okay. Even though these banks pose little threat to financial stability, they have had to bear the greatest burden from a heavy-handed regulatory approach by federal government. I've long been an advocate that banks should be hiring more loan officers than compliance officers. And this rings especially true for community banks. So, Mr. Betru, how has a greater regulatory burden affected the number of MDIs as well as the cost of credit to their customers?
Thank you. I think when talking about any of the regulatory issues, the number of capital rules worth considering, most of these come from, let's say, the Basel Committee and the Bank of International Settlements, as an example. In particular, there are rules around level of high-quality liquid assets, how much banks should be holding in reserves, should be right-sized to the inherent risk of the bank itself. MDIs in particular, given how small that they are, we know that most of them are below 1 billion in assets. I believe there's only a few that exceed that number. Yet the rules that govern them are pretty much exactly the same up and down the ladder. A couple of things to kind of give you an example of this. The number of foundations that want to participate in supporting access to capital and work with the various MDIs from the various Rockefeller foundations, Kresge foundations, is an unbelievable number. However, the way that they want to participate is by backstopping the credit risk that these different institutions have in providing access to capital, and they're willing to provide guarantees. These guarantees are governed not just between the two different institutions, but those rules are governed by different bank standards around capital adequacy rules, leverage ratios, and the like. Now, with these rules, it actually specifically stipulates whether or not a foundation that provides these guarantees treats those guarantees in terms of a high-quality liquid asset that can be both exchangeable within 30 days or tradable on the open market. That level of scrutiny has forced these foundations to say, well, the only way that we can provide this is in certain rules that actually will abide by Basel or the particular bank regulator that's engaged. Now, if we want to have the rest of the economy actually participate in pushing access to capital through the MDIs, we have to realize the exact rules that govern the capital adequacy rules, the liquidity ratios that these banks are subject to have to be in line with our overall objective. We can't have in one way support safety and soundness and then from the other side provide regulations that actually prevents that access to capital for underserved communities.
Thank you. Last week, I questioned CFPB Director Kraninger on the small business data collection provision contained in Section 1071 of Dodd-Frank. I've spoken with many community bankers in Texas about the political costs that this rule, or potential costs, that this rule would impose on smaller institutions. So, Ms. Sung, I understand that you operate a savings bank focusing primarily on mortgages. Can you talk about the HMDA data collection process for mortgages and why 1071 data collection process for small business loans could have an adverse effect on lending by community banks?
Yes, HMDA collection and reporting takes up 3 months of the 12 months of our lending season. We have about 6 people in our credit operations department. 2 of them, including my top senior credit officer, operations officer, is actually involved with the collection and ensuring the HMDA data is scrubbed carefully, properly matching the fields, and finally brought to, uploaded to the government website. I believe that this process would be very, very difficult, even more so difficult in the small business lending, even though I'm not 100% in that space. I understand what happens with residential lending, that at the very least you have a uniform residential application where you give to every single borrower, and that borrower is required to fill out those fields. In a small business lending, I was just at my Consumer Financial Service Committee meeting with ICBA. All small business lenders are saying a lot of them don't even use an application process in the beginning, and they're actually having different ways themselves customized to ensure that they are able to meet the credit needs of their community in the small business space. This alone is completely, it seems to me, going to be very impossible for these small business lenders to be able to create this uniformity to upload this data and collect it.
Thank you. The gentleman yields his time back. The gentleman from Missouri, Mr. Clay, who's also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Mr. Chairman, especially for conducting this hearing, and thank all of the witnesses for your attendance. I'll start with Mr. Betru. Data shows that MDIs operate predominantly in low and moderate income communities and have as their client base an overrepresentation of communities of color. Can you speak to the challenges of having a business model like that?
Sure. I think it's important to put that within the context of what is actually going to be financial services of tomorrow. There are currently a number of online and mobile banking services that are made themselves available post-2008. We talked earlier about what happened in the financial crisis in terms of the amount of wealth that was destroyed, the amount of home values that was destroyed, and the amount of bank closures that happened in 2008. What swept in was definitely a number of non-banks that were providing financial services. These financial service firms have a different set of rules with regards to the type of loans that they provide and different types of products. If we look at low and moderate income communities, they are still of the exact same ilk as any business where cash matters, speed in being able to obtain working capital loans, CapEx loans, and the like. Now, with the absence of minority depository institutions, what are they doing? They're going to the only sources that they find, whether it be payday-based or more reputable ones. And I think it's important to mention online firms in general are actually, there's a wide swath of them. We actually did an evaluation of more than 100 different institutions, different models, different approaches, so you can't paint them with the same brush.
But has the participation levels, have the actual lending improved as compared to a brick and mortar institution?
Absolutely. In fact, PayPal Working Capital in particular released a study back in, I believe, in 2017 that found that when they launched their service online, the vast majority of the customers that they serviced were principally minority and women in the zip codes where they saw a number of bank closures. So essentially, your answer to your question is yes.
Any explanation for that, or what are you hypothesizing?
Well, there's a mixture of things. Either A, we're talking about in financial services where because the banks were not in their zip codes, they went to alternative sources, and those alternative sources met the need of those particular borrowers.
Let me ask, thank you for that response. Let me ask Mr. Kelly and Mr. Bowman. Minority banks operate more than their peers in minority and LMI communities. They also continue to engage with minority small businesses which face significant discrimination from non-minority banks. How successful have you been in extending products and services to those who want to start a business in your community? Mr. Kelly, you can start.
Certainly, I will say, and thank you, Congressman Clay. In my opening comments, I mentioned in several cases we're the first and sometimes last resort for those entrepreneurs. You heard that ethnic minorities typically don't get to fund out of their home equity. They do it out of credit cards. That is just a metaphor for the challenges that we see within our communities. And that's why it is so important when you look at, on a pro rata share, these institutions serve a market that's typically left behind. It is our intention to continue to be focused on those in that space of the community and to try to provide services where they normally wouldn't have an alternative. That's not predatory.
I see. Mr. Bowman, anything you can add to that?
Yeah, I think a real live example is appropriate. We've conducted outreach into some of the other Native American reservations, looking for opportunities to help people. And it's really interesting because when they have a Native American banker approach them, they feel, I'm going to get a fair shake. So when I spent the first half of my career working for a giant money center bank, and the rules were very rigid. The guardrails are very narrow. If I utilize those lending guidelines to help that Native American borrow, I'm not going to make that loan. So what you have to figure out from an entrepreneurial standpoint is how I'm going to help. And so in the center of Wisconsin, there's a reservation, the Menominee Indian Reservation. It's 240,000 acres, 95% wooded. The primary industry is logging, and Menominee tribal members log that land. I have made equipment loans to loggers with no down payment, buying a piece of equipment, because if you don't have a down payment, you can't go to work.
I hear
Gentleman's
you.
time has
My
expired.
time is up. Thank you.
I now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Thank you, Mr. Chairman. I appreciate everybody on the panel here. It's a very interesting discussion, especially Mr. Bowman, kind of the direction you were going right there is some of the concerns I have, being from Georgia, who our state lost over 70 banks during the financial crisis, and we still have a lack of community banks, and that's one of the issues is the bank that is managed closest to the people understand the culture, they understand the people, they understand the needs, and it's like the federal government has come in and taken away the local decision-making that best fits that community. And Ranking Member Lukemeyer brought up Cecil, and I fully agree with his assessment on that. And when I talk to our community bankers in Georgia, and keep in mind, we still have 50 counties in the state that do not have a locally owned community bank or credit union in that county. We even have some counties that don't have a bank branch at all. And that's a big concern. And when I ask about the challenges our community banks face and why we don't have the creation of de novo banks, we haven't seen them come back. We've had a few, but they're just not coming back in the way that we think they should. I'm continually told it's like the death of 1,000 cuts. It isn't one thing, it's a multiplicity of things. And I see Cecil as that 1,001st cut into that because of the uncertainty. It's like, all right, we had a bad situation. Now let's just throw out an idea that's not tested, and we'll just see how the market reacts. And it's going to hurt the local communities more than anyone else if it fails. So, Ms. Sung, the scenario I've laid out with community bankers and just the not seeing a revival of those locally controlled banks because of the multiplicity of existing regulations, the uncertainty of new regulations. In your testimony, you said Congress and the banking regulators should pursue policies to promote the de novo banks and MDIs. Do you have any specific recommendations of those policies that we should be pursuing?
And there is a talk about this in the draft bill, and I believe the streamlined process to be able to apply as a de novo bank is extremely important. However, I also don't want to just base it upon an application process. I think it's important to allow these banks, once they apply and they're granted a charter, the ability to actually breathe and live. And that is in the capital a ratio requirement. You should not have a bank that's just starting and hasn't had a chance to live and to be something with a capital ratio requirement that's just equal to a high-risk, big money center bank. So I believe that one way to do this, other than streamlining, is create several tiers of capital requirements that are lower when the bank begins, and that as it grows and matures are as higher as it takes on more risk and it gets bigger.
And I agree with you. I think that's one of the problems we have with Dodd-Frank is lumping everybody into one category without consideration of the constituency or the customer base or the community. Ms. Falero, what are the biggest barriers to de novo credit unions, particularly MDIs?
I have to agree with Ms. Sung. The requirements to create a de novo credit union is extremely stringent. And then when they do get their charter, all the other requirements and all the compliance issues that the credit union has to come into terms with, it's extremely difficult for them to compete.
And Mr. Bowman, I appreciate your testimony because I remember when I started my business, under today's regulation, I would not have been able to establish a line of credit, but the bank president knew me, knew my character, knew me personally, and was willing to take a risk, and we ended up making a fairly successful business, and that's just been taken away from our banks. Mr. Kelly, how is BSA-AML playing in this issue of not being able to develop new banks? Do you feel that that the Bank Secrecy Act and the regulations around that play a factor?
Yes, I'll give you one example of that, Congressman. The Beneficial Owners Act that we have to comply with is very challenging. Now, the question is, we've been given the authority to be the police to know who is actually behind the business. But the reality is, most of those should be governmental records when someone get a license for a business, et cetera. So that's just one example where that burden needs to be taken off of the banking system. But the others have been old and maybe stale. One example would be, the cash requirements of $10,000. People don't use cash the same way they did 50 years ago, or 40 years ago when that was put in place, but we still have to adhere to it. And so that means I've got to have personnel in the back office ensuring that that's their job on a daily basis to be sure that we are tracking those. So we need a more comprehensive view of money and how it moves. And I agree that there are things we need to do to be sure that there aren't, detrimental or prerogative things happening inside of a bank. But the principles from 40 years ago don't apply today, and that's just one example of it.
Thank you for that. I yield back.
The gentleman's time has expired. I now recognize the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, and thank you to our panelists. This is something that, it's been worrying me for a long time. I'm just so worried that, the small community banks are going to go the way of the small community newspapers, and that our country will be poorer as a result. And so one question I had is whether fintechs, the competition from fintechs has landed disproportionately on minority-owned financial institutions. Anyone want to pick that up, either in the mortgage space, where I'm pretty sure it probably may have, and just in the general overall banking? Anyone?
Yes. So we looked at essentially what has been going on in terms of the access to capital in underserved markets, and in particular because of all the issues, again, with regards to lowering of assets, lowering of credit scores, the absence of the banks in low-income communities. Other providers of capital have definitely stepped in, the fintechs in particular. And again, as per my previous statement, there is a wide number of models and platforms, and so you can't paint everybody with the broad brush, the same brush. However, they're using technology in a way that a lot of the banks are having a hard time adopting because of a difference between the regulatory standards that the non-banks have versus the banks have. And so as you look at ensuring some of the rules with regards to fair lending, disparate impact, it's not at the same level. However, here's where regulation can actually go a little bit further. If you look at the access to capital mission of the CDFI space in particular, in targeting low-income individuals, specifically if I look at the small business sector, you've seen the banks essentially utilizing the entrepreneur's own credit score rather than the cash flow of the business. That's what the larger banks do in a business profile. However, utilizing that cash flow requires a completely different cost profile. Now, the fintechs have actually started to use technology in an unbelievable way to be able to do that. And so we actually did that test. We brought in a number of institutions and we looked at, can a cash flow-based methodology for providing access to capital to a small business in underserved markets actually, does that yield a positive outcome? And this is a study that we recently released with our partner organization, FinReg Lab, but yes, it does. But the issue is the ability for the banks to utilize that type of data is something that's regulated versus on the fintech side. Now, we've been asking this question, well, why can't the MDIs and the fintechs actually collaborate more? But this is another part around regulation. So third-party lending platforms, which are governed by the OCC, actually is a little bit more complex that allows a bank to partner with a fintech to utilize that technology, increase the access to capital. So in the absence of finding that regulation that enables that collaboration, fintechs have moved in and actually are doing it in a way that sometimes is a bit opaque.
Mm-hmm. Yeah, well, they come into all of our offices and say how wonderful they're going to provide services to the underbanked and so on and so forth, but they sound a lot like all of your traditional customers, that they're going to go cherry pick profitable opportunities and just make your life harder. And so that's, it's a double-bladed sword. We're also very interested in bias in algorithmic lending, but that may cause them to focus on traditional, mostly white groups so they've traditionally lent to, because that's their training set for their artificial intelligence, and leave your customers alone. And so I'm just wondering if, which way the sword is cutting here, and whether you feel like it's just putting all small banks under stress, or preferentially the minority-owned banks. Does it? Yeah, Mr. Bowman?
Thank you. So Wisconsin has 11 tribal communities. We're very big in one, small presence in others. FinTech has the opportunity, using this, to access those communities. One of the challenges is when you're a small community bank, you're a small business. Okay, we watch every penny, every dollar, and everything has got to be right every day for it to be a good business model. You could go to a FinTech conference and there would be 1,000 FinTechs there. How do you vet them? We have 27 employees. Who's going to vet them? So part of banking regulation is you have to have a scoring model for your vendor management program. They're now going to be a critical vendor just like your core processor. We're going to stumble. We need some help to figure that out. But that's the future. We need to embrace that.
Thank you.
The gentleman's time has expired. I now recognize the gentleman from Colorado, Mr. Tipton, for 5 minutes.
Thank you, Mr. Chairman. I appreciate you holding this hearing. Appreciate all of you taking the time. It's interesting, title of this on MDIs. I find it interesting, the commonality between the MDIs and my district in Colorado. Have 29 counties, small rural areas that qualify certainly for low to moderate income, more on the low income strata as well. As I've had the opportunity to be able to go through, we do have a CDFI that is active, First Southwest Bank, that is in our district to be able to make some loans. But those small community banks are echoing the very same concerns that you're putting out here today in terms of regulatory compliance and costs. And I think we probably have, I do want to certainly associate my thoughts with the ranking member's comments in regards to CECL as one more additional cost potentially that's going to be impactability to be able to make loans. But can we just go down the line? Do compliance costs impact your ability to be able to have profitability and to be able to make loans? Mr. Kelly?
Yes, it does.
Ms. Sung?
Yes, it absolutely does.
Ms. Falero?
Absolutely, it does.
Mr. Bowman?
Yes, absolutely.
Mr. Betru?
Not as a bank, but as a nonprofit, yes.
It does. Great. I thought listening to Mr. Kelly during his comments opening up, he said leadership matters, policy matters more. And that's the role I think that Congress needs to be actually being active in. We've had Chair Yellen before the full committee. We've had Chair Powell before the full committee. I have a piece of legislation called the Taylor Act, to be able to sculpt regulations to be able to meet the size, the risk portfolio of the institutions, rather than having one size fits all. I think many of us recall some of the comments after the passage of Dodd-Frank. The bigger banks, one CEO had noted, it becomes a moat around those big banks, making it harder for the smaller banks to be able to compete, simply because you can't keep up with the regulatory costs that are coming through. As we'd visited with Chair Yellen, as we'd visited as well with Chair Powell, the regulations aren't necessarily supposed to apply to the smaller institutions, but something called best practices comes in when the examiners come in the door. And so those costs do continue to multiply and inhibit that ability to be able to grow our communities. I had a very similar circumstance to Mr. Loudermilk when I started my business. Filled out a form to the Secretary of State, a sales tax license, got a character loan for $10,000, and I was in business. What bank can really do that today? You can. So you're one of the few that might be able to make some of those character type loans. But knowing the clientele that you work with, knowing your community, is something that ought to be respected by financial policy that is coming out of Washington, D.C., because it does have a real impact. You know, when we're looking at some of the MDIs, have you seen mergers between MDIs that have taken place? Is, Ms. Sung, you're nodding your head, or is some of this a practice really of regulatory costs, meaning that you've got to have the economy of scale to be able to just simply survive?
Yes, it's absolutely had to do that. I've seen 2 Asian American banks in my community in the past 12 months have merged because of that issue. AML-BSA compliance regulation is actually one of the highest regulatory costs. I would say 1/2 of my compliance resources are used to that particular regulation, and 1/3 of my board meetings are actually spent reviewing AML-BSA reports by my AML-BSA officer. So that's an enormous outweighted focus on one regulation.
Thank you for that. You know, we had a study that's put on by the Council of State Bank Supervisors, and they found that regulatory costs for state-chartered community banks rose 4.2% just in 2018. And as I've talked to my community banks throughout my district, we don't have a lot of the big banks that are actually there, but those regulatory costs and how that's impacting their profits, which ultimately impacts their ability to be able to pay the people that work there more and to be able to make those loans, has become an inhibiting factor for being able to help underserved and rural areas to be able to grow and to be able to provide jobs. So I appreciate, Mr. Chairman, you holding this, and invite you guys to take a look at this Taylor Act. I think it's something that might benefit you as well. Thank you, and I yield back, Mr. Chairman.
The gentleman's time has expired. I now recognize the gentlewoman from New York, Ms. Ocasio-Cortez, for 5 minutes.
Thank you, Mr. Chairman. And I'd like to thank all of our witnesses here for coming today. I think particularly when we're talking about issues like the wealth gap, it's important that we operate and have these discussions with the context of history. And in the United States, we have a long and ugly history of discrimination and economic discrimination. That history of discrimination and plunder has kept communities of color impoverished. And it's as apparent today as it was in 1865 when Lincoln signed the Freedmen's Savings and Trust Act. And it dates back to communities like in New York City, when one of New York City's first free black communities was demolished to build Central Park. I think it's important that we, again, recognize that context in history today and see where that inertia of injustice and identify where those areas may be in our present financial systems, whether it's for Native communities, black communities, Latino immigrant communities, et cetera. Minority depository institutions lend to minorities at dramatically higher rates. Is that correct, Mr. Kelly?
Representative, I'm not sure of that answer.
Okay. Is there someone on the panel that does know the answer to that question?
In terms of the portion of their total lending and total assets, they disproportionately focus on minorities more than others.
Okay, thank you, Mr. Betru. Is it also true that despite strong financial performance, minority depository institutions continue to struggle to raise capital?
Yes.
Why is that?
Well, there's a misconception, I would say, in terms of their efficiency. Essentially, there's a perception by MDIs, by virtue of the fact that they predominantly live within minority neighborhoods, that they are in and of themselves inefficient and essentially less likely to be a good investment source for an investor. And that is actually something that we at the Milken Institute wanted to challenge. So we decided to do an analysis of the return on assets and small business lending efficiencies of MDIs. We collated everything from 2002 to 2019 and did a data and envelope analysis and actually found that's actually not true. On a size-weighted basis, the efficiencies of MDIs versus non-MDIs was not different between those two cohorts. We're actually hoping to have this study published in the next week or two, but gets at this point. The perception of inefficiency belays the reality of what these institutions are doing.
So to clarify, minority depository institutions, by the books, are strong and exhibit strong financial performance, but they struggle to raise capital because of the perception that minority depository institutions are somehow a bad bet.
The perception blocks the ability of investors to support them and help them to scale. It is the scale, the fact that their inability to attract the right type of scale to defer the cost of compliance, the scale that actually drives the real drive towards efficiency. But it's a triumvirate of scale, perception, and a number of other compliance-related issues that all complete the problem that you're talking about.
Thank you very much for that insight. Ms. Falero, wanted to thank you for your testimony today. As I'm sure you're aware, during economic downturns, communities of color are almost always hit the hardest. We can look no further than the last financial crisis to see that. So as a lender to Puerto Rico, I'm interested in hearing how your organization approaches lending during economic downturns and some of the challenges that you face.
Well, thank you, Congresswoman Cortez, for that question. We're very proud to serve the community of Puerto Rico. We've had a branch there for 25 years, so we're very familiar with the needs and wants of that community. And during the hurricanes, we worked with our members, helped them as much as we could. We deferred their loan payments. We waived all their fees, late fees, ATM fees in the island, anything that we could do to assist them. We have a strong auto lending program right now in Puerto Rico. The unfortunate part of it is that since we are a credit union, we are very limited in our field of membership. So we're only able to serve 3 cities, Carolina, San Juan, and Trujillo Alto, because of the field of membership expansion rules that we have.
Thank you very much.
The gentlelady's time has expired. I now recognize the gentleman from Kentucky, Mr. Ball, for 5 minutes.
Thanks, Mr. Chairman. Appreciate the hearing, appreciate the testimony from the witnesses. Question about mortgage lending for all of you all, and we'll start with Mr. Kelly and work down the panel if you don't mind. At the conclusion of the promulgation of the qualified mortgage rule, did you observe a decline in the availability of mortgage credit, particularly as you reflect upon the fact that your institution serves low and moderate income borrowers?
Congressman, I'm not sure I understood the first part of your question.
So did you observe in serving your customers after the qualified mortgage rule went into effect that materially reduced access to mortgage credit for your customers?
Congressman, here's how I would answer that. We have seen it become more challenging for us for a number of reasons to compete in the marketplace. Some fintech related, as one of the witnesses have mentioned here, but also it's a combination of many things, and I'll give you one example. On CRA, we've seen larger banks be able to give rebates to customers for CRA credit, and these are much larger banks. We have to compete with that, and we can't compete with that. The point I'm trying to make is that for small institutions like ours, it is very difficult to play in the mortgage space with the compliance you have to support the scale that you have.
I guess what I'm
Some of
getting
the
at.
Some like
Go ahead.
HMDA, the following of the HMDA rules and all of those for us is a burden for us. And so for players who are in the 100 to 200 over the 2-year period, that becomes very challenging to spread that compliance cost based on the spread of where we can actually compete and place those mortgages in the market. That doesn't include the ones we keep on book in terms of our portfolio.
I guess what I'm getting at
Very
is,
challenging.
did the inflexible, rigid 43% debt-to-income rule limit your ability to originate mortgages for your customers?
The answer to that is a simple yes.
Yes, Mr. Sung, Ms. Sung.
When the Dodd-Frank rule came out on the qualified mortgage, we saw a tremendous drop in lending. It took me a year to get to review the rule and to understand the small creditor exception, which was very important for us to be able to continue to lend and to lend on our portfolio. I had to go to my regulator, despite the fact this was legislatively approved, to get them to approve. I had to literally write a research and white paper for them to accept and allow me to do this. To this day, they are continuing to monitor my lending in the small creditor exception space continuously. They are worried about concentration risks. I tell them that that is my mission, is to serve my community. And if my community cannot fall in the cookie cutter profile that other bigger banks are, I must go to that. However, they are concerned about concentration risk.
And Ms. Falero, did your members see a drop in access to mortgage credit after the qualified mortgage rule went into effect?
Unfortunately, we're not able to offer first mortgages right now because of the cost involved in our size credit union and all the regulations
So
involved.
you just got out of the business altogether.
We did.
So QMDU is quitting mortgages. Mr. Bowman.
So we did see a decline in lending. We're fortunate, though, however, because we have a niche product. We serve a Native American customer base. There's a product called the HUD Section 184 loan, and one of the eligibility requirements is you have to be an enrolled member of a federally recognized tribe. So our business continued when QMI came in. What suffered were the applicants that didn't qualify, that were non-Native American, that couldn't qualify for the specialty
Ms.
product.
Betru, I'm going to come back to you, but just for the other witnesses, I'm sorry that the CFPB's rule negatively impacted your customers. What we were able to do on a bipartisan basis in the last Congress was through a portfolio lending provision for institutions below $10 billion in consolidated assets is provide that portfolio lending relief. And our hope is, and our intent was, to provide your institutions and, more importantly, your customers that flexibility to access mortgage credit where you can retain that risk and hold those credits on your books. Last question to Mr. Betru, and that's what we were trying to remedy there. Mr. Betru, the valid when made doctrine, if we were to restore valid when made and overturn Madden, would that help invite fintech assistance for minority-owned institutions?
I believe on the valid when made component, I think that both sides of the argument have a valid point. On one end, you've got proponents that are making the right case that when a loan is made from a borrower and a provider of that financial services, having that clarity throughout the life of that loan makes absolute sense. I think the fact that we have differences with regards to what is affordable across multiple states, in some places like in Utah where there are no usury laws, is putting a little bit of consternation for various lenders. That being said, from a fintech's perspective, they are operating throughout multiple different jurisdictions. I think the biggest point that we have to figure out is the banks that are sitting here are dealing with a different regulatory regime than the non-banks, and bringing parity to that absolutely makes sense. In the absence of that parity, I think the situation we're dealing with is we have fintechs that are able to provide a type of financing that a lot of these banks are not.
The gentleman's time has expired. I now recognize the gentleman from Florida, Mr. Lawson, for 5 minutes.
Thank you, Mr. Chairman, and welcome to the committee. Mr. Kelly, could you tell me, I was just trying to figure out how many African-American banks are still in existence? Or do you have that number?
22.
There's a round number that I would say is roughly around 21, 22.
Okay.
Is a number in the country out of roughly 5,500 plus banks.
Okay, the other question would be, and I might know some of the answers, but I would like to hear some of the answers from you, y'all aware. What led to the major decline? It wasn't a financial crisis, it probably started before then, but what led to the major decline of African-American banks?
I would say it's a host of things. You heard, I think it was Representative Loudermilk mention it's death by 1,000 cuts, and that is been prevalent, in the industry. The challenges that you heard him describe in Georgia, I think Georgia lost more banks than any other state in the country. These are not MDIs, but I think it's somewhat prevalent. The other aspect of it that I would say to you, Congressman, is the propensity of where African-American banks were built. You heard Congressman Scott mention there hasn't been one chartered in 20 plus years. Our banks were centered in the heart of what used to be the middle-class African-American community, where the doctors, the physicians, et cetera, lived. Some of that was because of the redlining issues that the Congresswoman made reference to, but the reality is through kind of some of the changes in our economy where you saw people move away from the city into the suburbs, our institutions weren't capable of being able to deliver beyond the brick and mortar and the circumferences that they were built in. And so you saw kind of a decline of business activity around some of these institutions that have been somewhat challenging for them.
Mr., I can't see it from here.
Betru.
Betru, yeah. Would you like to comment on that?
Sure. I think in answering your question, I think it's important to take the Congresswoman's comment earlier about making a historical context point. I think when we look at middle of this previous century dealing with redlining, it wasn't, at least on paper, an overt racist issue. It was utilizing the construct of these markets are too risky to engage in. Now, if we're talking about the failure of MDIs in quotations, and I don't believe that the failure is an accurate description, it is a mixture of everything that happened post-2008 in terms of the individuals being targeted by certain unscrupulous mortgage lenders, their wealth being destroyed, as eventually those institutions that served them felt the brunt of the 2008 crisis. And post, what did we do? We started introducing a number of regulatory standards that were unfairly at parity between an institution that is sub 1 billion in assets with all the other banks. So in essence, are we looking at introducing, it's too risky for these banks to operate in these areas in a similar way that's unfair? The MDIs are 250 billion in assets, the entire 150 of them. 250 billion. That's like 1% of the total assets of the all 5,500 institutions. Yet we're subjecting them to the exact same level of regulatory scrutiny as we have other banks north of $200 billion in assets. If we want them to actually deploy capital to the exact communities that need it, then we have to right-size the rules that which govern them.
That's amazing. And the last question is, if I have enough time, it seems like the credit unions that are associated with a university seem to have a much higher opportunity to survive during the financial crisis and so forth. Is it because they have a built-in depositories that are used from the universities, especially with minority universities? Is that one of the reasons why you can still find credit unions associated with the universities in many of the cities where there are minority institutions? Mr. Bowman, did you act that you wanted to say something?
Well, I work in the banking industry, and I think I would defer to her. She runs a credit union.
Congressman, yes, I work at a credit union, and I believe the reason why credit unions are a little bit more able to survive is the way we do our loans. We're very conservative, highly regulated, and our mission in life is to deal with the underserved. That's what we do.
Okay, I yield back, Mr. Chairman.
Thank you. I'm now going to yield a minute and a half to the ranking member for a closing statement.
Thank you, Mr. Chairman, and thank each one of you for being here today. You've done a great job of stating your case and informing us. It's been very informational for me to be able to ascertain some of the things that I think are important. You know, I think from the standpoint of small banks and credit unions provide money resources to the communities that you serve. You know, you have the same problems that every small community bank, every small credit union in the country's got from the standpoint of compliance costs. It's just through the roof. It's driving consolidation. It's driving them out of business. And we need to find ways to minimize that, if not get rid of it altogether. Obviously, my focus has been on CECL today because I think it's a huge problem for, our economy, and especially for small banks and credit unions in particular, from the standpoint of having to reserve more money for that. And there's only one place to go get that, and that's when you make that loan. And that's going to raise the cost. It's going to keep people from having access to credit. You know, I think one of the things we talked about, I think Ms. Sung talked about, was concentration of credit or concentration of risk. You know, if you're doing a good job of representing your community, you're going to be investing in a community. You know what you're going to do? You're going to have a lot of risk in your community because that's where your risk is. That's where you want to do. You want to improve your community. So as a small institution, yeah, you have your investments in the community, and that's where your risk is. But if you do a good job of, and this is where the analysis of the regulator needs to be, and as a former regulator, I can tell you some of them do a good job and some of them don't. You wind up, some folks don't want to do their job and they're lazy, but they need to go in there and depend on you to give them a review of the economic activity in your area and how you can help interact with that and build a better community. So each of you, as I can see, have your community at heart. I thank you for that. And with that, I'll yield back to balance my time to the chairman.
Thank you. First, let me ask unanimous consent to enter certain documents into record. One, statements for the record submitted by the Credit Union National Association, the Creative Investment Research, and the Inclusive and its network of CDFI credit unions. Also, without objection, I ask for unanimous consent and on submitting a document of an article published on the OCC website entitled Citibank, Partnering with Community Banks to Expand Financial Access, which speaks out about Citi's program, which provides over 440,000 customers of 25 participating community banks, minority deposit institutions, and federal credit unions with surcharge-free access at 2,300 Citibank branch ATMs. Now I recognize myself for a minute and a half on a closing statement. As we conclude this hearing, I first wish to thank the witnesses for your testimony and for choosing to tackle some of the most difficult challenges in banking, namely ensuring access to financial services for marginalized, underbanked, and discriminated communities. We sometimes portray banking and bankers as a monolith, but it is a complex and diverse industry that is reflective of the diversity of America, but it's also reflective of the problems in America. We cannot allow minority banks to disappear, and we must work in earnest to tackle the challenges of banking deserts, discrimination in lending, and foster genuine diversity in the banking sector. If we do that, and why we must do that, because that is the way we close the wealth gap. If we look at what took place prior to 2008, we were closing the wealth gap. But after 2008 and the crises, when individuals in minority communities were most directly affected, that wealth gap just blew open. And we're not lending in the way or having access to capital in the way that we should in our minority developed MDI banks. So, I've taken note, I've been listening very carefully, of the feedback on my bill, and I will work to make appropriate changes ahead of its introduction I must close with thanking, again, Chairwoman Waters for putting issues of diversity and inclusion at the heart of our committee's work, as well as congratulate my colleague, Ms. Beatty, for her able leadership on the D&I subcommittee. But I also want to thank my colleagues from across the aisle, Mr. McHenry and Ms. Wagner, and of course, the ranking member of this committee, Mr. Lukemeyer, for engaging with us constructively on issues of diversity, and in particular on today's hearing on minority banks and tackling issues faced by underbanked communities. These issues cut across parties and districts, and I believe that our work here matters to the vulnerable communities we all represent in Congress. Again, I thank the witnesses for their testimony today, and without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to their chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. And without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is now adjourned.